Vishal Khandelwal, founder of Safal Innovation, joins us. Before I go to Vishal, I must admit on this public forum that I follow his blog and his website very closely, and I'm a very proud tribe member of his website Safal Innovation. Tribe member, right?
Yeah, is it?
35,000 and the number has gone. Last time you told me it was 35,000.
Now it's 40.
Now it's 40. Yeah, so the number is growing.
Yeah.
So fantastic to have you back, and thank you for joining us. We can cover a range of topics with you as to what investors should do or what they should not do versus what books you're reading versus what blogs you are reading. What should we start with? I'll keep it open.
I think anything, man. Anything. I think things to avoid are my favorite topics. So I think what investors should not be doing. So maybe we can start with 2017 and move to 2018.
Okay, so let's start with 2017. What do you think has been a good avoid for this year?
No, I think 2017 broadly has been a good year for investors, especially those guys who've stuck to their stocks rather than trading in and out of stories. But I think more than the dream part of the year, I think 2017 brought to light a lot of risks. And I think the bigger risk that has come, especially for me, how I look at it, is that people don't see any risk on the horizon. I think that's the biggest risk that investors have. We saw more themes, more investors getting it right in 2017 versus a lesser number of people who got it wrong. And I understand that when more people start getting it right in stock markets, I think it's a time to run for covers. So 2017 has been a good year at 20% for the Sensex, and I think a lot of stocks did around 5 baggers, 10 baggers kind of stuff. So we are into a dangerous territory as far as I can see, 2018. A lot of people have started seeking views on 2018, so I offer them two kind of views. The simpler, shorter view is that I don't know, and the longer view is when I quote Howard Marks, who says that the investment business is full of people who got famous for being right once in a row. I don't want to be that kind of a person who wants to be right, so I don't want to venture out predicting what 2008 has in store, except I still want to make a prediction, and my prediction is that things won't change. People won't change, people will be greedy, people will be envious of others making money faster, there will be a greater exaggeration of the fear of missing out. So I think things are not going to change, and I for once will be proven right. So I think that's...
But if that fear of missing out would remain, why would 2018 be risky then? Because every dip will be bought into by people who've missed out on the 2017 rally.
I think that's the entire point. If you invest because you know what you're investing into, that's good, right? So buying into something which is falling because you understand that it's worthwhile, it's good. But when you buy something just because you fear missing out on the potential gains, because you've seen actual gains in recent past, I think that's what is scary. I think most of our decisions in life is made, especially in stock markets, are made because we are envious of others, and fear of missing out is actually a result of being envious of others. I think people will make money faster, people close to you will make money faster. It's not a disaster. So,
fear and envy, two factors which all
big factors. It's not greed and envy. I think it's fear and envy. I think envy is the biggest.
It's like Madhu always tells us, what drives investors to a stock market? जब पड़ोसी का पैसा बन जाता है.
That's it.
Okay. Now, what drives? Bull markets typically peak when there is a valuation froth and then there is a participation froth. Yeah. The valuation froth is not there. Yeah. And participation froth, I can argue that if I look at F&O positions, if I look at the SIP culture, which has about started, less than 3% Indians are indirectly or directly invested in equities. So some would argue that just because prices have gone higher, should we worry about participation froth, and should we worry about the market positioning? Because the US bull market has lasted for 9 years.
Yeah.
And if you sold out in the first or the second, third year, you never really creamed the bull.
That's true. So I think it's dangerous to touch your compounding machine, especially when you had the vision of buying good quality business and had the courage of actually buying them. I think all you need is the patience of holding on to them. But I think the thing that you're talking about in terms of participation froth, valuation froth, I think we were talking the same things in 2017. Even then, Indians were less than 2% Indians were participating in stock markets, and people were talking about that number going to say 5%, 10%, which is a huge thing. So my worry is not about, or I think I am an optimist about Indian stock markets and investing in India, and I see more and more people coming to the equity culture. But my point is that how do people behave when they are starting to make money fast, right? Like we've seen in the last few years. So people have short memories. It's very important for us to understand that. And the second thing is that the last real pain point was in 2008, which is 10 years, almost 10 years behind us. So short memory plus something painful not happening in 10 years, I think these two are not good situations to be in.
Are you saying that there could be a repeat of 2008?
I'm not saying that. But what I see around me, and as you understand, that more and more people who are making money in the stock market at this point of time did not witness the pain of 2008.
Yeah.
So if you did not witness a painful period like
It's a
2008, I'm not
new
saying
set
it's
of
going to
people.
repeat. Yeah, it's a
Yeah.
new set of guys, but the same kind of mentality. So if people have no real experience except reading theory books of painful periods, I think they make mistakes.
You know, when
So
a Da Vinci is sold for $500 million and Bitcoin does the way it does, you tend to get
You
worried
know,
that
the
what is
frenzies.
happening. No, what is happening to risk? I mean, you just take things for granted, and when the leverage trade it kicks in, you just know which way the bent of the market is.
that is true. That's true.
Would you read too much into what's happening into Bitcoin or the way Da Vinci is sold? You know, Nilesh Shah Kotak told me that don't look at anything,
Yeah.
but look at a painting indicator.
Yeah.
Look at how global paintings are sold.
That's right.
And after 2 years, you will see a crack somewhere because of outlandish valuations.
I think it's always a greater fool theory. It's seen in stock market. It's especially seen in art and stuff like Bitcoin. I may be talking about Bitcoin pro or anti, but the simple point is that I don't understand. I think most people don't understand Bitcoin, whether they are pro
Everybody has a
Bitcoin.
view, but
Even when they are bashing a Bitcoin, they don't understand Bitcoin. So I think we need to focus on what we understand. We need to be in a circle of competence in investing, I think, everywhere.
So what is your circle of investing telling you? Will what's worked in 2017 work in 2018, or is it going to be a fresh, clutch of horses that you would have to bet on in 2018?
So I am a bottom-up stock picker. I really don't really go by themes, but over the next few years, I think the broader themes that I'm looking at is largely related to consumption. And when I say consumption, I am looking more at ancillary businesses which are going to support that consumption. So they may be media businesses, they may be consumer food businesses, they may be ancillary businesses to say automobile or real estate demand, all this kind of stuff. So consumption is something that I am looking at positively over a long period of time, given the right valuations. Another theme, broader theme is I'm looking at businesses, or I think it's good to look at businesses which are changing their colors for the positive. So businesses where people thought they are commodity kind of businesses who are moving towards from low margin kind of stuff to high margin.
can you give me an example?
It's
not a stock
Yeah, so
recommendation,
I
but
think
just
look at businesses where the guys were used to selling to industries, maybe tires. For example, just as an example, where Indian tire companies generally have been selling a lot of stuff to OEMs. Now, a lot of them are actually creating brands, building brands, and shifting a lot of their business to consumers. So the margins on a whole have been rising. Of course, they've been supported by rubber prices, but that's one of example of shifting business trends. And again, without going into any specific industry, I think the investors would do well if they look for companies where they think that the balance sheet has been a bit troublesome, but the management has been good, and they are trying to make the balance sheet maybe more asset light, giving away a lot of debt on the balance sheet. So those kind of changing themes are something that I'm looking at over a longer period of time, given the right valuations. That's a big if. Yeah.
One is where you get into the market, but where do you get out? Because there is that froth and valuation which is getting a little uncomfortable now.
I think that's a very important question, but my personal investment philosophy of the past, I think, couple of years is that I buy and I don't sell. Right, so if your financial goals is not in the next 5 years, 10 years, there's no point trying to book profit or trying to get out. Right? What do you do with that money that you sold off? There's a huge reinvestment risk, right? So what do you do with that money? So if you can find good quality businesses, and if you have your financial goal, which is 5-10 years down the line, you simply ride onto those businesses till the time they remain good. So buy and don't sell is my philosophy.
Where are you on this entire debate of power of concentration? Buffett says that if you diversify, you minimize the upside. If Paul, the gentleman who invested in Valiant is a clear example that diversification also has backfired.
Yeah, that's
so for an ordinary investor who's, let's say, watching this show, what should be the nature of diversification? Don't hold anything more than 5% in a stock, or if you understand it, go to as high as 15%.
I think retail defensive investors who are not full-time into investing should not really be worried about portfolio sizing as a subject. So what I advise people is to have equal weightage to different kind of stocks. So if you want to have 15 stocks in a portfolio, which is a good number, which is I think 15 to 20 is the maximum one should hold, right? So if you want to have that kind of portfolio, you may have around 6 or 7 or 10% per stock in your portfolio. So that's one way of looking at it. A more easier way of looking at diversification or how many stocks one should hold is where I believe Peter Lynch theory works very well. He said that owning stocks is like having children. Don't have more than you can manage, right? So I think
When I have one son, that does not mean I should buy one stock.
no, yeah, that's fine. That's fine. It depends on entirely how you can manage, how well you can, how peacefully you can sleep at night. I think investing boils down to that factor. So
Okay, now I know you read a lot, and since I track your blogs and I track some of your newsletters, I get these lovely book recommendations from you
that's
time
right.
and again.
That's right.
Typically, when we ask investors for a book recommendation, it has to be a Buffett book.
Yeah.
It has to be a Munger book.
Yeah.
But the author whom you're suggesting right now is Peter Belvin.
There are two authors, in fact. There are
Okay.
two books which I want to talk about. The first is Principles by Ray Dalio, which came out in 2017.
Did you see an interview last week?
Yeah, I saw that. I've been reading, I've been seeing interviews, I've been listening to all podcasts of Ray Dalio.
It was an eye-opener for me.
Yeah, so he's a wonderful guy in terms of the kind of ways he's sharing his secrets, his principles, and he himself regrets that if the world would have been a better place if more and more people who've been successful could come out and share their principles. So Principles by Ray Dalio is one enlightening book that I found in 2017, and the other book that you talked about is written by a guy called Peter Belvin. And the name of the book is actually a quote from Charlie Munger. The name is All I Want to Know Is Where I'm Going to Die, so I Will Never Go There. So the crux of the matter, and applies very well to investing, is that if you know what can kill you, you don't do those kind of things. So betting on things that you don't understand, betting on bad promoters, betting on chore companies, right? If you think that something can kill you, please don't do that.
So what could kill you in 2018 is chore companies?
I think it's a very interesting point that you've raised. I think a lot of people are talking about chore companies just to take advantage of that valuation arbitrage that they can have because they are available cheap. But I think this reminds me of a game called Russian roulette. So in Russian roulette, you have a gun with 6 chambers and 1 bullet, and 5 out of the 6 times you'll get richer and you'll be happier, but 1 time you'll become a statistic, and a statistics that the world will not fondly remain. So again, I think going back to a guy called Phelps, who wrote a wonderful book called Thomas Phelps, I think, who wrote a wonderful book called 100 to 1. He said, stay away from people who steal from others because someday they'll steal from you. So with chore companies and chore managements, I understand people don't change, they just change their colors. So it's very important to not give into that hype about buying any kind of business at any kind of valuation. Stuck with good quality business,
But
I think.
Vishal, if you buy something which is well recognized, you have this term called cherry consensus, which Howard Marks often uses.
That's right.
And he says that you will never get a good entry price if you buy something where the cherry consensus is strong. Don't focus on where the puck has moved, focus on where the puck would move.
That's true.
So if I go by a theory that focus on good companies, good
right.
compounding machines,
That's
great managements, a lot of those businesses are already been discovered, at least in this current market cycle.
That's true. I think you're talking about this and everybody knows about this. I think that's the biggest mistake that people are making, is that they are missing out on the obvious opportunities in front of them. So a lot of small investors I see, they are talking about micro caps, small caps, which is good, which is a good way of finding out where the puck is moving. But the very fact is that for every one large cap stock which is tracked by, say, 100 analysts in the market, there's one small cap stock which is tracked by, say, 1,000 small investors. So everyone knows everything about companies. Things are very obvious in front of us. But I see in amidst all this, I see a lot of obvious stories, obvious companies which have done well for investors in terms of business quality, looking to do well in the future, but people miss out because they all want to focus on the next big idea.
Which is your all-time favorite stock?
I don't really talk stock specific, but I think in terms of businesses which have done really well over a long period of time, I think obvious businesses, again, they were obvious in 2008, 5 as well. So things like Asian Paints, Pidilite, Titan, I think they're all there. They're all there.
Where are you on this entire debate on value versus business? If you buy a good business at a bad price, it may not be a good investment. But if you buy a mediocre business at a good price, it may turn out to be a good investment.
I think with mediocre business, you have to answer a lot of tough questions.
Is good.
The price is good, that's perfectly fine. But I think Charlie Munger says that a piece of turd with a raisin is still a piece of turd, right? So it's very important to not really go by any quality of business just because they are available cheap. A very diversified portfolio like what Ben Graham would have done, a portfolio of, say, 100 stocks, you could have bought worthless companies just because they were available cheap. But in today's world, and especially in a country like India where corporate governance or management quality is so important, I think it's very important to stick with good quality business and wait for them till they fall to reasonable valuations, and stocks fall. I think stocks fall to these good quality businesses. Do
So
that.
in your notes, and in the do's and don'ts section especially, you're
Yeah.
saying that with a 5-year view, stay overweight on equities. What about the next year?
Anything beyond
Because
5
you
years,
seem
yeah.
a little cautious and very uneasy about the outlook on 2018.
No, not really. So outlook on to 2018, I am cautious just because I'm suffering from a recency bias. I've seen stock markets doing well, and I've seen people taking a lot of risks. So I think this is not going to change if markets continue to do well as they did in 2017. I think investing is a loser's game, and what I mean by it being a loser's game is that if you want to win, you have to avoid losing. Right, so if you want to really make it big in 2018 or beyond, you have to avoid a lot of mistakes, a lot of stupid mistakes that people get into. And people, despite knowing what I am saying, despite knowing that, right, people will still make mistakes. So I think that's the irony
That's
of
the
investing.
human nature.
That's human
Okay,
nature, yeah.
so really closing comments, and this is really about an investment approach. As of now, the SIP culture has picked up, and it's a great culture because you are investing in dips and bits, and you're investing throughout the year.
That's
So
true.
you really capitalize on the uptrend,
That's true.
and in the downside, you minimize your risk also. But there are about 1,200 schemes,
Yeah,
and the asset allocation in a scheme also matters.
that's true.
Would you say that if you're planning to start a new SIP, don't start in a mid and a small cap fund, go for the large cap funds now?
So, so this is what I advise. So I'll suggest what I advise to my family members who want to start into mutual funds. I ask them to go with diversified funds.
Okay.
I ask them to go, if they're starting fresh, I want them to really start with say 5 funds. One may be a diversified fund, one may be a tax saver if they want, one may be a small cap and a mid cap fund, one can be a large cap fund, all those kind of stuff, right? So diversification works very well. One can be a balanced fund as well. So I think they do well if you choose them carefully. So I will not really ask them to avoid small mid cap companies or funds in that sense, but I think ask them to be very careful with the kind of funds that they choose, and then stick with them whether the market's doing bad or they are doing well. So a lot of people start with SIPs in good quality market, good markets, and then they start withdrawing their SIPs or they start stopping their SIPs in bad markets. I think that's not a good way to make money. I think you just do it. You just keep on
Stay
doing
the
it.
course.
Stay the course. I
Keep
think
with
that's,
it.
yeah.
Okay, Vishal, thanks
Thank
so
you.
much for taking the time out.